This is a presentation that I gave recently to a group of economics and business and accounting and finance majors at the University of North Carolina, Greensboro, and I wanted to record it for others who may be interested. And so that's what this talk is. I started off the talk with a nice interaction with the folks in the room, learning about what it is that they're looking forward to achieving in finance or investment banking or various things that they want to do, wealth management and so on with their degrees, work in corporate finance, accounting, etc. And so this talk is intended to be of service to folks who are going into those types of fields and are getting economics majors on the way. Um, just to share a little bit about myself as a starting point for this and why it is that I'm up here talking about this. Um, I graduated from Duke University in 2004 and was initially working in the sustainability office there after graduation. And then I went to work for the Association for the Advancement of Sustainability in Higher Education, where I was working with about 1,000 colleges and universities. Eventually, we grew to that size, incorporating sustainability into their work and their operations and their curricula. And then I went to work on procurement and supply chains with Fortune 500 companies, federal agencies, states, local governments, and did that for 7 years. And then I was working on an events-based project around the United Nations Sustainable Development Goals, also known as the 2030 Global Goals, when the COVID pandemic took off, and that affected that. And today I am working or I'm a master's student in the Graduate and Liberal Studies program at Duke University, and I am part of a collaborative called the Money Justice Collaborative, where we do trainings and education for social movement leaders that are in social movement organizations that are interested in understanding how money works and why it's flowing in the ways that it is in the economy, and maybe why it's not flowing in the ways that would be helpful for solving some of the world's problems. And as you saw in my career path, my primary interest and focus has been the sustainability of the human species on planet Earth and what it is that we need to do to change about our economy and our supply chains and our and even the education that we're about how to in as after they graduate from universities so that we can create a society that can be sustained for many generations. And this work that I'm doing, as you'll hear in a moment, is related to that. But just to say, I've been working on this for a few years. Have made created some database and tools, some of which you'll see today that have contributed to the field. So that's kind of where I've been. It doesn't explain quite why I've pivoted and care so much about money and am so focused on that today. So when I was growing up, I remember my dad telling us at the dinner table that his parents and grandparents had lost everything. That's how he would say it, in three financial crashes. And you talk about the savings lost, the business lost, the home almost lost if it weren't for intervention of neighbors. And I remember being traumatized, terrified, by the idea that a financial crisis on Wall Street could potentially leave us homeless. And it terrified my dad too. And that's really one of the reasons why he became a small town financial advisor in Greensboro, North Carolina. And it was in part because he was passionate about protecting his family and other families from financial crashes, and as he liked to say, helping make sure that they owned the pillow that they slept on. And so over breakfast, he would, read the financial news and talk to us about the financial markets and investing. So I learned a lot about that over time. It wasn't, like you saw a focus of my career, but it did play a powerful role throughout my life. In particular, drawing my attention to how the money system really works. So not just the markets, which is what I learned with my dad, but like how the creation of money works, how that influences the economy. And that's what this whole talk is about. So if that doesn't ring a bell, don't worry. The 2008 crisis was, a big wake-up call for me. Lots of people, it was that terrifying scenario that my dad had told me about. Many people had the experience that my dad was afraid of, losing their businesses, losing their homes, losing their savings. And as I was watching that experience, I went and did and learned a lot about banking and the money system and why it is that that so much money could kind of evaporate so quickly. And uh, at that time, I learned about something called fractional reserve lending. And when I was speaking with the students live in the auditorium, I had them raise their hands and tell me if they had ever heard of something called fractional reserve lending, and pretty much all of them had, because that's something that's taught in our schools, as we'll talk about. And the second kind of big awakening for me around this and time where I really decided that I wanted to focus on this was the COVID pandemic. And, we saw millions of people losing their jobs, losing their health insurance and so on, having to burn through their savings, uh, all for no fault of their own, right? And I thought to myself, if there's ever a time when we should create money out of thin air, this is it to backfill people's incomes when they have been put out of work again for no fault of their own. And so that brought me back to this idea of fractional reserve lending, which many of folks in the audience already knew. We'll talk a little about it in a bit. But basically, this is the story that banks are able to expand the money supply by creating new money out of thin air. And I was really surprised to discover when I was looking back into this in 2020 to discover that this story that I learned in macroeconomics that's in our textbooks is not correct. And in fact, what this conversation, that was a very robust conversation that was happening, was saying is actually we have a 100% credit creation banking system, and we'll talk more about what that means. But basically, it means that every time a bank makes a loan, they are creating 100% of the money that they're lending out. It's not some fractional system. We'll go into that in a bit more detail in a minute. But really importantly, in addition to these folks in law schools, in banks, and central banks, and so on, that we're talking about this fact that things work a little bit different in the banking system. And I should say that what was interesting about that literature was that it had exploded after the 2008 crisis, and in particular after about 2010, 2012, and then really after 2014. And the reason is that the 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 2008 crisis awakened a lot of people to banking and like, how does this work exactly? How could this have happened? And in the process of looking at that, they discovered, legal scholars, accounting scholars, some economists, and so on, that it just doesn't work the way that they'd been taught. And and then they started to not only say, hey, maybe we should reconsider the way this works because it caused this huge crisis, but also when we had the quantitative easing, the textbook explanations of how money works wasn't matching up with what was actually happening. And so this robust conversation developed. And uh, uh, in addition to kind of how does this affect our financial instability and so on, there was a conversation that I found in the literature of many scholars saying, you know what, this isn't just a good idea to change this because it would make our economy more stable and so on. We really have to change it because how it works today is increasing inequality. It is driving up housing costs and household debt burdens. It is hurting small businesses and local economies. It is leading to cuts in education and healthcare. It's fueling polluting industries, and it's causing economic crises and stagnation. And these are people around the world looking at this and saying, wow, the way our nations are creating money today, creating the money supply that we use, is just, we really need to rethink it, right? And this isn't, like I said, this is a global movement that I discovered of academics around the world, but also activists in social movements and in grassroots and other things. In fact, we'll talk about a bit about a group called Positive Money in the United Kingdom that had a really big influence on this whole space and on me. And then there's the insiders. There are people in the Bank of England and the International Monetary Fund and the Financial Times and so on saying, hey, we really need to rethink this. So in this talk, my goal for the students in the auditorium and for anyone watching this video is that by the end, you'll have a better understanding of money, banking, and macroeconomy than most mainstream economists do. And I want to be really clear about what I mean by mainstream economists. And again, we'll talk more about this. But and this was true in the auditorium, that I asked people, how many different schools of economic thought have you been exposed to? There's neoclassical, classical, Keynesian, post-Keynesian, feminist economics, ecological economics, Marxist economics, labor economics. There's Austrian economics. There's a lot of different types of economics, and basically they didn't even know what the question I was asking, because in their economics education, they had really kind of only been taught one type of economics, and they didn't know that there were more. And so that type of economics that is predominantly taught, almost overwhelmingly taught in our schools today is called neoclassical economics. And if you've been learning things like, the money is neutral, if you just adjust for real versus nominal values, if you're using, dynamic, stochastic, general equilibrium models, supply demand curves, all of this is neoclassical economics. It's not to say that some of these other types of economics don't also use some of those tools, but they have very different emphases, and they also do have some different tools that produce different results. So it's not to say that all economists don't have a really strong understanding of money and banking and the macroeconomy and the relationship between those three things. But there is evidence that, and you'll see this again later, that there are schools of thought that are not the mainstream that have a much better understanding of this. And it is a gap in the understanding of the mainstream neoclassical economics. You will also have a better understanding of how business is done and how it's not done, how investment flows to some things and not to other things. And you will be able to ask hard questions about why our money system works the way it does and if it's a good idea. And you'll get to decide what you think about. Obviously, I'm on this because I believe that there is something should be changed about it. I'm among those groups of folks that are calling for change. So, I just told you my story a bit in the auditorium. We had a chance to get some of the stories of some of the folks in the room. And now let's move into kind of the content, which is, where does money come from today? And then I'm going to tell you about a Copernican shift, and that's not my term. Well, others have used the term that there's a Copernican shift going on in the understanding of the macroeconomy, and it's not a Copernican shift that you may have heard about in your mainstream economics classes, but it is happening, and I do believe you'll be hearing about it more and more. And then I just want to conclude by showing you that there are some other ways that we could orient the relationship between money, banking, and the economy. So where does money come from today? How is it created? And in the auditorium, I gave folks a chance to just call that out. And, they said things like it's, created in fractional reserve banking. It's created by the central bank. It's printed by the mint or by the government or by the central bank and so on. And what I want to talk today is about a particular part of the money supply and how it's created, right? So um, about 80% of people, we actually have the research data, about 85% of people do believe that the government creates our money, that it's the bank or the central bank or the central government, the treasury, the mint that is creating the money that we use. And in fact, only about 10% of the money that we use is created that way. And so here you can see the government bills and coins, according to the Federal Reserve, makes up about 10% of the money supply. So what is the rest of that money, right? And I asked the folks in the audience, and they were able to tell me it's bank money. It only exists as electronic numbers in our bank accounts, right? It goes by multiple names. Uh, it's called bank credit in literature a lot of the times. Uh, More familiarly, we know it as bank deposits. And if you are in economics and you are in finance and so on, you will sometimes hear people say, and some of the people in the audience the other day also said that this was true, that you'll hear people say, "Oh, bank credit isn't money because it's credit." And credit is an IOU, and you and I can make an IOU to each other, and that's not money. So bank credit is an IOU, and therefore it's not money because it's the same idea. But this is not the case. It's pretty clear, and this is an economics professor who's taught more people economics and banking, the economics of money and banking than probably anyone in the world. He's got an online class. His name is Perry Marilling. He has an online class that over 100,000 people have taken. And in that class, you will hear him say, if you go and take it, and I recommend it, it's a great explanation for how money and banking and financial markets and money markets work today. Um, I will say I really appreciate everything I've learned from Perry Marilling. I do think that if you do take that class, you'll see that he presents how it works today as kind of an inevitable conclusion of an evolutionary process by which we've arrived at the money system that we have today. That is something that I would contest. I would say that we have had, humans have invented thousands of ways of creating the money that their societies use. And I would say that some of those ways are better than others, and some of those ways are better than the system that we have today. I would also say that the way that the system that we have today arrived to kind of be the way around the world is pretty clearly a legacy of colonization and colonization by capitalist countries who were using this system. And so I don't think that there's anything inevitable about the system that we have today. And I think that that's important to keep in mind because it means that, we can change it. Um, and, but in any case, in his class, Barry Marilyn says, in a world where a private bank's liabilities, its credit, are widely accepted as a medium of exchange, banks can and do create both credit and money. And so when Citibank signs an IOU, it's money. And when I sign an IOU, it's credit, right? So again, in our world, and you've experienced this personally, your bank deposits are money. You can pay your bills with them. Our taxes are collected in them by our government. They want you to pay them in bank deposit, in bank credits. They don't, it's very hard to pay your IRS bill in the United States with cash. There's actually a great article where an economist tried to do that and found that they have made it as difficult as possible. So bank credit is what we use. That is our money supply. And that's just an important point that I want to clarify when speaking to finance and econ folks. So where does bank money come from? And the typical answer is, right, this fractional reserve lending process. And what's surprising, and this publication I'm about to tell you about is in 2014, the Bank of England published a bulletin titled Money Creation in the Modern Economy. And they published it in part because so many questions were being raised after the 2008 crisis, and in particular when the quantitative easing began in 2010, 11, 12. By people saying, wait a minute, what's happening here just doesn't match what we've been taught. And they published this bulletin because there was a parliamentary hearing that was being held, in part because this group Positive Money, which is an activist group of citizens who were concerned about the economy and the financial markets and the banking system, were raising very publicly and with their parliamentarians all of these questions about why are our textbooks telling us that the way money and banking work is one way and it's actually this other way. And so the Bank of England published this bulletin to clarify the situation. I highly recommend reading it. It's a very clear document. And it says in the opening paragraphs, whenever a bank makes a loan, it creates a deposit in the borrower's bank account, thereby creating new money. And this description of how money is created differs from the story found in some economics textbooks. Okay, so right off the bat, they're coming into the conversation saying, yeah, we agree with you that the textbooks are wrong. And there's actually a really interesting study that was done in 2008 that found that it was actually 91% of undergraduate economics textbooks incorrectly teach how money is created in the relationship between banking and central banking and so on. Interestingly, the ratio even goes down when you get to graduate school textbooks, but for a different reason, which is that most graduate school textbooks don't even really teach you anything about how money or banking works because it just completely abstracts from those things into these mathematical formulas that really don't even have any variable in them for money creation, as we'll see also in a bit. So what is this thing? Let's get a little bit more concrete about what is it, this thing that textbooks teach about how banks create money that isn't correct. If you've ever heard of deposit multiplication or fractional reserve lending, these are the stories that they're referring to. And the way that this story is typically told is a customer walks into the bank with $100 in government-created currency. They deposit it. The bank sets aside 10% in reserves, and then it lends out the other $90. And that person takes that $90. Oh, by the way, really importantly, while it has lent out the other $90, it continues to tell the original depositor that they have $100 in their account, even though they've lent out the 90, right? And therefore the money supply has expanded because they think they've got $100 in their account. And in fact, they do, in the sense that they can go out and write a check and it will clear. And the person who borrowed has $90 in their account or in cash in their hands, and they think they've got $90, right? So this is how the story goes, that banking expands the money supply, and there's now $190 in the economy, whereas there was only $100 of government created money at the beginning. And so these 10% of reserves are what are required by the central bank, and that controls how quickly the money supply can expand. And this process can go on and on and on, where the person who got the $90 now deposits in the banks, 10% set aside, lend it out, and the money supply can just grow and grow. So that's the story that's told in textbooks. This is the Federal Reserve now weighing in on this, and in a book that they published, actually, Modern Money Mechanics Spain, which they say, of course, they, meaning the banks, do not really pay out loans from the money they receive as deposits. If they did this, no additional money would be created, right? So they do not really pay out loans from the money they receive as deposits because, in fact, what they're doing is creating new money. And the really important aspect here, this is actually a court case, and this is quite recent, 2020. 33 banking law scholars, submitted an amicus brief on a court case about financial technologies. And they, these are Harvard Law School, Duke University Law School, Vanderbilt Law School, Cornell Law School, and they all came together and they wrote this brief and they said, hey, it's really important, Judge, that you understand that when banks make a loan, it posts a credit in the amount of the loan to the borrower's deposit account. It need not have any cash on hand, right? Okay. So what they're calling attention to and what's wrong about the fractional reserve story is that the whole thing begins with cash on hand, with government money created coming in that's set aside 10% and 90% is lent out. This is not the case. In fact, every time a bank makes a loan, 100% of the money that they're lending was created newly. And what that looks like is just the bank accounts, the bank's balance sheet expanded. There was no money moved from one account to another. Right about now, usually people ask, and there was interested in this in the auditorium the other day. Are these folks who are writing these bulletins and these court cases and so on, are they saying that banks can create an unlimited amount of money? No, they are not saying banks can create an unlimited amount of money. What they're saying is that the process of money creation that banks engage in does not begin with having to accumulate a scarce amount of capital from depositors. It originates in a legal privilege to create money. And we'll talk more about that. But it's a crucial, crucial difference. Importantly, this legal privilege to create money that banks have does not allow them to just create money for themselves. That would be really wild if banks could just create money and stick it in their pockets, right? They have to have a willing borrower for whom they're creating the money. And the interest paid on the borrowed money when it's repaid is what the bank gets to keep for itself. It's kind of the idea is that that's their service fee for having provided the service of vetting, borrowers and picked the right ones and, manage the bill collection and, repayment, whatever else. So they don't get to create the principal that they create for the borrower, and they can't create principal without having a credit-worthy willing borrower. And so the primary limit, one of the most important limits on bank money creation, is the availability of willing borrowers, right? So, somebody asked in the auditorium the other day, they said, well, can't, the banks just kind of create somehow work it out where they can just create money like let's say in 2008, right? So we know there are limits, right? Because banks weren't able to just create money out of thin air in 2008 to solve their balance sheet problems. But interestingly, actually, the question that the student asked was a really good one, because in fact, some of the largest banks did exactly that. Credit Suisse and Barclays Bank were both taken to court because they basically had relationships with very large wealthy customers like Qatar and the United Arab Emirates, and they went to them and said, "Hey, will you take out a loan of say $10 billion from us and then use it to buy equity in our business, and that'll recapitalize our business?" And the United Arab Emirates and Qatar, said, sure, as long as you pay us for the interest that we're going to incur with this loan, we're happy to do that for you. And that's literally one of the ways that they survived the 2008 crisis balance sheet contraction. So that was illegal. That was illegal, to be clear. But just to say that what they were having to overcome right there was a limitation in not being able to find willing borrowers in that moment with which to expand their balance sheet, or rather, I should say, fix their balance sheet. So there are also legal limits to how much money banks can create, such as capital adequacy rules and liquidity regulations. I'm not going to go into what those are. You can look at them online. But I think an important thing to note about these regulations is that functionally, they advantage very big banks, and they do not stop banking crises. We had capital adequacy requirements and liquidity regulations and so on. We've had them in many countries for a long time, and they did not stop the 2008 crisis, right? So we have limits. The limits are not effective in stopping crises, and they also advantage big banks, which leads to monopoly. And just so that you can get maybe a story to help that. Imagine that Tesla, a very bankable large corporation, wants to build a gigafactory outside of Reno, Nevada, as they did, and they need to borrow $10 billion to do it. If the local bank in Reno, they might say, wow, we would love to do that loan. We'll make interest on $10 billion. They wouldn't be able to do it because they are not big enough, don't have enough capital with which to make that, with which to be able to meet their regulatory requirements for that loan, even though the way that they would create that money for Tesla is exactly the same way that a giant bank on Wall Street will do it, right? Which is that they will create new money out of thin air or out of a legal privilege to create money and add it to their balance sheet, right? So again, this clearly means that this capital adequacy requirement is limiting a small bank's ability to do the same business that a big bank can do. So what about central bank reserves? The textbook says central bank reserves, that 10% reserve requirement is what, makes is what actually limits the money creation. And that does not. It has actually never limited the money creation. And many countries have never had reserve requirements, and the United States has a 0% reserve requirement since 2020. Um, so that going back to that Bank of England bulletin, what it says is that speaking about this whole money multiplier, reserve ratio idea, is it says the textbook teaching that reserves are multiplied up, central bank reserves, it is not an accurate description of how money is created in reality. In reality, neither are reserves a binding constraint on lending, nor does the central bank fix the amount of reserves that are available. The relationship between these reserves and loans typically operates in the reverse way that is described in economics textbooks. And again, we're talking about 91%. And what they're saying is that the banks actually, central banks actually create reserves on demand in response to commercial banks or the banks that you and I interface with when they want them, right? And to make this make sense, but yeah, so they're created on demand when banks want them. They're not limited by the central bank. And the reason they're created on demand is because central banking actually emerged out of bank clearinghouses. So the original central banks were bank clearinghouses. And the purpose of a bank clearinghouse was to allow banks to more easily make payments to each other. And so the reserves of those bank clearinghouses, or they called them certificates in some, reserves in others, the purpose of them was simply to represent little debts between banks, and they only needed as many as they needed to represent the debts that they were passing around and clearing. And for that reason, that for most of the Federal Reserve and most central banks' history, the amount of reserves has been really, really small because banks don't actually want reserves. They just want, these tickets with which they can clear payments with each other. So because the purpose of the reserves is to help them clear payments with each other, the central bank doesn't withhold them when they are looking to make payments with each other because that would freeze up the payment system. Instead, they create as many as are needed by the banks to do payments. Right? So this is what they're saying when they say it's the reverse. Instead of the central bank creating reserves and the banking sector being limited by that, the banking sector creates money when doing lending and then they see each other reserves they were to settle those payments. Okay, so we've just, with the help of some central banks there and some banking scholars in court, kind of poked some holes and declared some of these things that are found in our textbooks to not be accurate. So how do banks create money really? And this is a fairly famous quote among people who are in this space by an eminent economist from the last century. His name John Kenneth Galbraith. And he said, the process by which banks create money is so simple, the mind is repelled, right? And actually, there's a great story by a banking regulator and legal scholar named Saleh Omarova, who was nearly the comptroller of the United States currency. She speaks about going into meetings and hearing, people say that banks are just creating all of the money that they're lending. And then the regulatory conversation and so on would then everybody would nod their heads and then they would proceed and the whole conversation would unfold with the logic that the reason that the way banks work is that they've pre-accumulated scarce capital and they are representing that scarce capital in making loans. So there's this way in which even when people are told or understand how it actually works, it does just repel the mind. And I can say that is true. My father, who I mentioned earlier, I have explained this to him a number of times, and he spent 35 years thinking that banks are lending out depositor savings, and frequently I have to kind of remind him, no, that's not the case. It's you hear it on the media, you hear it in the news. Silicon Valley Bank failed because it couldn't actually pay its depositors because it had lent out the money. You've got these stories are everywhere, but that's not actually, what happened. So, how exactly does a bank create money? Let's go through it. So step number one, a borrower signs a loan contract. The bank cannot create that money legally without a creditworthy borrower who signed a loan contract promising to bring it back plus interest. Right? Step two, the loan officer types the amount of loan into the bank software. And then in the background, the bank software takes that loan contract and puts it on the balance sheet of the bank as an asset because it's worth something to the bank. The borrower is going to have to pay it back over time plus interest. And then it enters in the customer's account, which is credit of the bank, that it owes the customer the amount of the deposit, or sorry, the amount of the loan, right? And all of that takes place, in the background in the software. But what we know is that no money is taken from any other account when making the loan. No central bank reserves are touched, right? No new reserves are created or set aside or anything like that. So again, because this repels the mind, let's just go through it one more time. Step one, the bank has to have a borrower, signs a loan contract. Step two, the loan officer types the amount of loan into the bank software. Step three, the accounting software, type or adds new money into the borrower's account and records the loan as an asset of the bank. No money is taken from any other account when making the loan, and no central bank reserves are touched. And I emphasize the accounting software a little bit there because, believe it or not, like this story, this correct information about how banks expand their balance sheets and create new money about. And actually, in 2014, there was a banking scholar from trained at Oxford who said, Richard Warner here, he said, why are we debating this when there's, banks who use all the, thousands of banks that use the same accounting software? Why don't we just go look at what the accounting software does, and that will tell us, right? And so he tested the bank accounting software and found that, sure enough, the fractional reserve story of lending doesn't match what's happening there, as does just the idea that banks are intermediaries who are simply, playing a matchmaker role between depositors and borrowers and taking a fee for that service, which is kind of another way that you'll hear banking described. The other reason I emphasize the accounting piece is because most bank employees do not know. They're not the ones actually, making the accounting records in the balance sheets of the banks. What they know is they type the numbers into the accounting software and then the loan gets made, right? And we actually know because of research that only about 26% of people working in the financial sector know that bank loans are entirely new money, right? And so, a number of you want to go work in finance, you want to go work in banking or in, investment banking, et cetera. Hopefully you're not going to be one of those, 74% who do not know this, right? And what's actually very interesting, I have a friend who works in stress testing at one of the largest banks in the world in London. And, we both are pretty interested in this topic and talk about it a lot. And he told me that, even within a giant bank like that, even within the stress testing department that really understands the balance sheets of banks and has to understand the balance sheets of banks really, really carefully, he'll have conversations with his colleagues and say, yeah, our bank is just creating new money every time it makes a loan, and people will kind of look puzzled for a second and then they'll think about it and they say, oh yeah, of course that's how it works, but and they'll say, yeah, it makes sense, it's fine. But what's interesting about that story is that it's not part of their daily thinking, right? It's not top of mind, right? So even when the conversation comes up, they have to think about it and go, wait, is that true? We're just creating money every time we make a loan. What Saleh Omarova calls the master narrative, that banks are lending out depositor savings, accumulating scarce capital, and that's why they have, the privilege to be the ones making the loans in the economy or investment decisions. That that is that story is so powerful that even people working in stress testing at some of the largest banks in the world just don't have it top of mind that they're creating money every time they're making a loan. And so again, as I said at the beginning, one of my goals is to help prepare you with information about money, banking, the economy that is somewhat rare and hopefully helpful to you. I don't want you to take my word for it that this is rare and helpful information. This is the head of the Monetary and Economic Department for the Bank for International Settlements, Claudio Borio. And the Bank for International Settlements, if you haven't heard of it, it's called the Central Bank for Banks. And it is the coordinating body for central banks around the world. It also provides, payment services and things for coordinating about his experience moving from academia and his Oxford, training in economics to working at a central bank and at the Bank for International Settlements.
All of the models of banks that we had studied at university actually abstracted from capital. If I wanted to be a good economist here at an institution that works for central banks, I had to broaden my horizons. So I worked in financial markets, I worked in banking, and worked in regulation and supervision. I even taught myself accounting. Then I worked a lot on payments and settlement systems. I worked on monetary policy implementation. And there I did learn that everything that I had learned at university was wrong, that it had bear no resemblance to what was going on in the real world. And that was a major eye-opener.
Excuse me, I drank some water and did it too quickly. But you heard Claudio there say that, these models that he learned in school about how money and banking work, they didn't match reality. And he had to go and teach himself things like accounting and how, interest rates and monetary policy really are, influencing the money creation in the banking sector more than reserve requirements. He didn't say that explicitly, but this is, you heard it directly. So again, earlier I talked about mainstream economics, kind of your classical, neoclassical economics. And I said that there are all these other schools of economics, right? And so some of the ones that I mentioned here on the right have a better understanding and I should add the Austrian economist to this slide. These are folks that if you study in these schools, many of them have a better idea of how this works. There's a check mark next to the post-Keynesians because the post-Keynesians are the ones that really, as far as I know, have the clearest on-the-record published, predictions of the 2008 crisis. So while the neoclassical economists really just missed the 2008 crisis, they completely failed to predict it. And many mainstream economists, declared it unpredictable. It was just a black swan event, a long tail phenomenon that was so impossible to predict because the probability of it was so small. The post-Keynesian economists were like, no, we saw it coming. We published papers saying that it was coming and so on. And the reason is that they use different models. They use, as we'll see, they're using accounting models instead of these completely abstracted mathematical models. So just to say that you've heard a little bit here from me and from some of these central banks that this is true, that banks are using, they have a legal privilege to create 100% of the money that they lend. I just want you to know, and you can pause the screen to look at these, or you can go to the New Banking Consensus database, where we have over 140 citations of central banks, academic economists, published statements by legal scholars and commercial banks and so on. Joining the Bank of England and so on, and the Federal Reserve, and saying that this is the case. Now, again, I don't think you or anyone should take this from me. It's a pretty big claim to say, the textbooks are wrong, and the way that banks are coming up with the investment, the money that they're lending out is that they're exercising a legal privilege to expand their balance sheets and create new deposits. So I just do want you to hear it from the horse's mouth in a couple of ways here. This is actually a video that was released by the Bank of England when they published that bulletin in 2014, and strangely, I don't know why, they decided to record a video about it in their gold vault. And I'm just going to play a clip from it, but I think you'll hear pretty clearly the economists at the Bank of England, explaining that banks do not lend out pre-accumulated savings. They're in fact creating the money that they lend.
Ryland, your article is about how money gets created. We're surrounded here by gold in the vaults of the Bank of England, and historically in the gold standard, the amount of gold would have been related to the stock of money in the economy. Things are very different now. In the modern economy, where does money come from?
Well, let's start off with narrow or central bank money. As the name suggests, central bank money is determined by the Bank of England and consists of notes and reserves. And in normal times at least, notes and reserves are determined by the amount of notes that people want to hold or need for their transactions, and the amount of notes and reserves that banks want to hold, given the level of interest rates in the economy. It is not chosen or fixed by the central bank, as is sometimes described in some economics textbooks.
Your article focuses on broad money. What determines how much of that there is?
Well, broad money, which in many ways is a better measure of the amount of money circulating in the economy, includes all the bank deposits of households and companies. And one of the key points of the article is that banks create additional broad money whenever they make a loan. Now, while this is nothing new, it is sometimes overlooked as the main way in which money is created, and it runs contrary to the view sometimes put forward that banks can only lend out deposits that they already have. In fact, loans create deposits, not the other way around.
Great. So in addition to hearing that banks are creating deposits, not lending out pre-accumulated savings, you also heard him say, and this is not what's in the textbooks. So that was a central banker. Now I want you to hear from a banker. And this is Michael Kumhoff, who is a former Barclays banker. He then was at the International Monetary Fund, and he's now one of the senior economists at the Bank of England. And he's written about this extensively. He has a paper in particular that says banks are not the intermediaries of loanable funds, and another one called the Chicago Plan Revisited. These are important papers in this.
Basically, the banks sit there, they wait for deposits to arrive, and if they have enough deposits, they lend them out to somebody else. And that is completely wrong. This is the wrong model of banks, because what happens in reality is exactly the opposite. And I've done this, I'm a banker, I know that that's how it works, and you can read it on many central bank websites, that's how it works. Is that banks, when they decide the economy is good, we are optimistic, we are now making loans, they don't need to wait for any deposits, because when they make a loan, they create the deposit. Right there, banks create money.
Michael Kumhoff, like I said, wrote a paper called Banks Are Not Intermediaries of Loanable Funds. And what for you as economists will be interesting about that paper is that he specifically breaks down, what it is that's missing in the DSGE models, and points out that DSGE models don't even have bank money creation in them because they assume that investments equal savings, when in fact, this next one is now a banking scholar. This is Richard Warner. He is the economist that I told you about earlier who conducted the study of bank accounting software. And I said, can we just put this to rest already? And here's what he has to say about it.
Now, banking actually has not been very well understood. There have been three theories of banking, and they've existed and coexisted for at least the past century. The most dominant one currently is still the financial intermediation theory of banking. And nobody had ever done an empirical test. So I thought, well, since these theories are mutually contradicting, when it comes to the crucial question of where does the money come from when you get a loan from the bank? Well, let's figure it out. Let's do an empirical test. So I did this and published 2014 and 2016 two papers. The conclusion is the financial intermediation theory was rejected. Banks are not financial intermediaries. You may have heard of the fractional reserve theory, slightly older. That one was also rejected. It says that banks lend money out of reserves, and they don't. Financial intermediation theory says they lend out of other people's deposits, and they don't. So the oldest theory was the one that was found to be correct, and that's the credit creation theory, which was known 100 years ago, which is why one of the papers is called Lost Century in Economics. Banks create money out of nothing through the process of credit creation. So banks are special. They create the money supply, 97% in most countries of the money supply out of nothing through the process of what's called credit creation. Now, the recognition of bank credit creation is a game changer to solve many of the world's problems, such as the recurring banking crises can be prevented, unemployment can be solved, business cycles, underdevelopment, depletion of finite resources. All these problems can be solved by utilizing the power of bank credit creation.
Great. I love how YouTube always throws up a bunch of random videos. So I want to just note there that Richard, at the end was saying, this reality that banks have this special legally granted privilege to create money, which is how I would say it instead of saying, banks are creating money out of thin air. They're not. They're creating money because they have an exclusive legal privilege to do that. This privilege, he says, hey, this thing where we can create money can be used. We can change, what he's saying is we can change how the money's being created to be channeled towards solutions and other things, and we'll look more at that. But just wanted to kind of name that that's an aspect that's ahead that I think is very positive. I agree with him. So while banks cannot create an unlimited amount of money, they do create a lot of money. This is the growth in the money supply in the United States just since 1960. And as you can see, the quantity of money has been growing radically. And I cut it off there at 2019 just to get kind of before the COVID piece. The post-COVID piece is we can talk about another time. And so no matter how much banks can create, there are folks, and I'm one of them, who believes that this is not fair, right? So most of us, what we're told is that the way to build wealth is we need to go out and work really hard, and then we need to save our pennies, and then we invest those so that we can grow a nest egg and to retire on. But what banks get to do is they get to use their legal privilege to create money, to invest. That's what's happening when they're buying loan contracts or buying bonds. They're investing. That's the same thing that you or I could do. We could make a loan to somebody at interest, or we could we could buy bonds and treasury bonds and so on. And so they get to invest and then they earn, right? It's almost the reverse process. And as a result, the banking industry is the most profitable industry in the United States and has been for a while. It has a product to sell that everybody needs, and it costs virtually nothing to produce it. So it makes sense that they're so profitable. And I think it's worth noting at this point that this privilege and this power is extremely profitable. And the fact that it's extremely profitable probably explains the fact that the economics textbooks have been teaching this story called fractional reserve lending for the last 70 years. Really, the first best-selling textbook that was explicitly teaching that story was published in 1948 by Paul Samuelson. And it has taken over the textbook since then. It is in every textbook. And at no point in the last 70 years has the banking industry decided to clink a glass, grab the microphone, have its PR people get them on the CNBC news and say, it's come to our attention, that the textbooks are wrong and we want to correct the record, right? That has not happened. And I would suggest that the reason that hasn't happened is because, this is an extremely profitable business model. And if it was, clear to everyone that the reason banks have the privilege to be the ones making the investment decisions that are, shaping the economy, as we'll talk about in a minute here, is because they have been given a specially legally granted privilege, that might be contested. And in fact, we have research that shows that 86% of people, when this is explained to them, just the fact that most of our money is created by banks, are ready to contest that and say, wait a minute, that doesn't seem right. Why do private for-profit banks get to decide who gets newly created money? Okay, so we just finished the part. Where does money come from today? I hope that was clear. I hope also that it was valuable to be able to kind of hear directly from people who are working on this. And now I want to talk about that Copernican shift in economic thinking. So Copernicus and was the shift where we went from thinking that the Earth was the center of the universe and the sun goes around it and the stars go around it, to the idea that actually the sun is at the center of our galaxy and not even at the center of the universe, and Earth is going around that. And some people have called this awakening to the truth of how bank money creation works a Copernican shift in our understanding of the relationship between money and the economy and banking and the economy. And what I'm particularly talking about here is that what you'll see, or what I'm going to show you, is that the money system, the way our money system is currently designed, where our governments have outsourced the privilege to create the nation's money supply to private for-profit banks, is powerfully modulating the strength of our economy, the health of the economy. It is also placing an infinite economic growth demand on the economy. And it is also structuring the economy. It's deciding kind of what sectors grow, what regions grow, and so on. So those are big claims. I want to break it down and let you decide for yourself. But the starting point for that is that if you believe, and you can go to your own research and decide whether or not you believe these folks that I've been talking or showing you here, if banks create money every time they make a loan, then what that means is that we have to change our understanding of the relationship between money and the economy. And that is because, according to research, most people think that the relationship between money and the economy is as follows. And this is how I and the members of the Money Justice Collaborative that I do workshops with also used to think. Most of us believe that there's a relatively fixed amount of money in the economy and that we're passing it back and forth. And that's what makes the economy spin. And we believe that it's a really bad idea to add money to this quantity of money, this scarce quantity of government-created money, because that will always cause inflation. Right? This is what average people believe, and many people in policy and other places as well. And we believe this because it is literally what is taught in the best-selling textbooks to this day. This figure right here is called a circular flow diagram. It is found in the opening chapters of most economics textbooks. And what it shows, I just simplified it for you, is money circulating in a closed loop. No money is being added and deleted from the economy, and banks are not even in the diagram, right? So here's your picture of the economy. The whole economy is just households and businesses passing money back and forth. Choosing products, going to work, choosing products, going to work. And we are the ones that are spinning the economy through our purchasing and labor choices. And so again, this looks very similar to what I just showed you. But if you believe, and you get to decide for yourself, if you believe that, in fact, the case is that banks are creating 100% of the money that they're lending every single time they make a loan, or even fractionally, if you think they're making 90%, either way, then you know that this picture cannot be correct, right? It cannot be a closed system. If banks are creating money every time they make a loan, then it has to be an open system, and there has to be a faucet, and that faucet is bank loans. And this is the quantities here that we're talking about that banks are creating every year are really large. In the United States, it's $21 trillion per year between 2016 and 2019 that was being created by the banks. And just to put that in perspective, the Federal Reserve reports that in those 4 years, the amount of money in existence, according to the Fed, was only $14 trillion on average across those 4 years, right? So that should probably seem strange, right? There's more money being created every year by the banking sector in lending than there is in existence, according to the Federal Reserve. And so that raises the question, if banks are creating so much money when making loans, shouldn't the economy just be overflowing with money? Now, the Bank of England's bulletin tells us why this isn't happening. And actually, in your textbooks, there'll usually be one sentence where it will say, oh yeah, when the loan is repaid, the money is destroyed. And that is the case. When bank loans are repaid, the accounting process, and I'm talking here about the principal, when the principal is repaid, the accounting process that created the money for the loan in the first place is simply reversed. And what this means is that when you repay your loan, when you repay the principal, it doesn't go anywhere. It doesn't go to pay anyone else ever again. It just goes out of existence. So huge amounts of money are also being deleted every year from the economy. And we don't notice these huge flows, these huge inflows and outflows of money into the economy, in part because they're digital, but also because they're fairly well balanced. In the average year, about the same amount of money is going in as is coming out, with just a little bit left over as an increase in the money supply. So the situation is trillions in, trillions out, and fractions of a trillion left over as a residual. And so one of the problems with many macroeconomic models is that they leave out bank lending altogether. They literally don't have a variable in their equations for it. But when they do, it is usually only the net flow, that 0.4 trillion that they include in their macroeconomic models of the economy. And this is in part because banks are not required to report detailed data about the origination and repayment flows. The numbers that I just showed you were actually, they had to be extrapolated from data taken from the Federal Reserve and the Federal Deposit Insurance Corporation and so on. There is actually better data in Europe. The European Central Bank collects origination and repayment data from their banks. And what I can tell you from looking at that data is that the pattern is very similar. We're talking about huge flows of originations and repayments every year. So we think that this data, for the United States that's been extrapolated is pretty good. Now, again, as economists, you've been introduced to dynamic stochastic general equilibrium models. And I told you earlier that Michael Kumhoff wrote a paper about the gaps in that model, but there are others who have called attention to it as well. And just to say that, as I just said, they literally don't have variables in the equations for money creation and deletion, and often don't even have an equation, a variable for that net. The closest they have, as Dirk Bessemer writes here, he's one of the folks who uses accounting models and is part of that, kind of post-Keynesian group who were the ones who predicted the 2008 crisis. He wrote in 2016 and said, if you look at these models, really when it comes to these financial flows, they only have even one variable, which is the interest rate. And as Michael Kumhoff points out in his paper, is that even when mainstream economic models do include bank money creation, they frequently only use that net flow, the 0.4 trillion. And again, this is in part because the data for the full flows is difficult to get. Okay, so that's all background. That's this, like, wow, there's a really big flow going on here, and the system is very open. But I said to you that I'm going to show you that that flow is modulating the strength of the economy. So let's look at that. Now, because those flows are so large, it might make sense to you already, that a more accurate way to think about the relationship between money and the economy is that the money flowing from the faucet to the drain is spinning the economy, not that the economy is circulating a fixed amount of money. And in fact, research shows that to be true. Economies slow down and speed up in close synchronization. The slide says almost perfect synchronization. That's not correct. There are other things that influence certainly how much the economy speeds up and slows down. Fiscal interventions by governments can make a huge difference. But in general, there's powerful evidence, empirical evidence that that for example, there's a study here that showed that it was the one by Schuleric there, credit booms gone bust. They tested a bunch of macroeconomic variables and came away and said, really, bank money creation, it predicts banking crises and financial recessions better than any other variable we tested. Interest rates, investment rates, unemployment rates, tax rates, growth rates, anything. So going back to Dirk here, why is it that that some of these modelers were able to predict the slowdown of the 2008 crisis better? And the reason is, he says, that there's an immediate link between accounting and the ability of some economists to predict the 2008 crisis. With a few exceptions, this point seems to have been overlooked to date. And that is the answer to the soul searching that the macroeconomists and the neoclassical economics did after the 2008 crisis. And it's not just the post-Keynesians who are calling attention to this. This is Joseph Stiglitz, a Nobel Prize winning economist, who said, to me, the strangest aspect of modern macroeconomics, especially during the Great Recession, was that central banks were using a model in which banks and financial markets played no role. So again, these mathematical models that are not actually adding up the amount of money in the economy and where it is and doing the accounting of it are misleading us, and even our central bankers who are using them. So coming back to that 2008 crisis, now some of the things that went on during that time make sense. So even while, the models didn't include banking and didn't predict, the crisis, what you saw in the aftermath was that a lot of conversation from economists, central bankers, and politicians all saying, how do we get the banks lending again, right? And it's because, now you understand, banks are the headwater of the economy. And when the faucet turns off, the economy slows down. When the faucet opens up, you have a booming economy like we did in 2006, 2007. Okay, so now on to part two. The money system demands endless economic growth. So over the life of a loan, more money is drawn out of the economy than is initially put in. And this is because the money for the loan was created, but the money for the interest was not, right? And you can see that. And this double drain means the money supply in the real economy, that's you and I live, where cars are made and people buy cars and homes are built and people live in homes and so on. The real economy versus the financial economy. These are not my terms. These are actually terms used in the field of economics for 100 years. They're able to split the economy into these two things. The financial economy is, stocks and bonds and, these types of things where people are trading paper and not actually, building cars. This double drain means that the money supply in the real economy will automatically shrink, right? And that's because without some money being created to fill in the interest money that's being taken out, there isn't enough money being put into the system to both repay the loans and the interest. And the interest is growing exponentially, right? Interest is compounding, so we have a growth demand that is growing exponentially. So this double drain is what keeps the human species on an economic hamster wheel, right? Mathematically, there's never enough money in the economy to repay all the debts plus interest. And what this means is that either we keep on coming up with new reasons to take out loans and grow the economy, or some portion of the population unavoidably has to fall into debt, foreclosure, or bankruptcy through no fault of their own. It's just an artifact of the money system not being balanced, essentially. And what we see is both. The fact that people are coming up short drives a popular and political demand to keep on searching for new ways to grow all the time, how to make new products that people don't actually want, and pay advertisers to figure out how to make them want it, and so on, just so that we can grow the economy and stop having unemployment and stop having people, be in, onerous debt and so on. And so once money enters the financial economy, so it's important to note that the money from the interest does not go out of existence, right? So the bank gets to keep that, but it goes into what's something, as I mentioned earlier, called the financial economy. Over, the shareholders that get paid out from the bank, the top earners in the banks themselves, are the wealthiest households in the economy. They don't actually need more spending power. They're not going to go buy 25 more jets and 500 more cars, just because their bank started paying out more money in their income. Instead, what they're going to do is invest that income. Right? So 90% of all stocks are owned by the top 20% of wealth households. I think it's about 60% is owned by the top 10%, about 30% I think is owned by the top 1%. I need to check those numbers, but it's something like that. So right, these folks, what they're going to do is they're interested in always accumulating more. They have the belief that money should earn money, and so they're looking for places to lend it at interest, and that is where the money goes, right? Only a small portion is spent back into the economy. And what this means is that both sources of investment that's flowing into the economy is debt-based. Most of the money or basically all the money that's flowing into the economy through the system is arriving as a short-term or long-term loan that has to be paid back plus interest. So whether it's bank money that's going to produce a profit for the bank and go into the financial economy, or it's saved money from high wealth households that's being lent back into the economy, both of them are requiring more money come out of the real economy than is put in. And what's important about that is that besides the fact that it's kind of constantly draining the real economy and keeping us on a hamster wheel, is that it means that there's a relationship between the interest rate and the financial economy, and how fast it's draining the real economy and how fast it's growing the financial economy. When the interest rate goes up dramatically, as it did in the last couple of years, that higher interest rate means that we have a faster growing financial economy, is a higher portion of money is coming in off of all those loans. And all that money goes into the savings accounts or the investment accounts of those high wealth households. They have asset managers whose job it is to go out there and find places to put that money. They're not allowed to just let it sit there in cash, not earning interest. And so they have to go out and just find something to buy, and they go out and they buy real estate and bonds and stocks, even if they're, just driving up the price and paying more than they should for them. And this creates what's called an everything bubble. And you've seen that in the last few years. While interest rates went really high, banks are making record profits, and just about every financial asset in the financial economy has been rising in value, right? So again, I'm just trying to show you here how there's aspects of the design of our money system that does things like create an economic growth demand, create financial bubbles, create everything bubbles, and so on. So this whole system is organized around a goal, which is bank profit maximization, right? So the rate of new lending, the terms of the loans, the interest rate being charged, is all being maximized by very smart people in banks who are, twisting those knobs essentially for the purpose of producing as much income for the financial economy for the shareholders of the banks as possible. It's not our national money system is not being managed, for the purpose of public well-being and securing, full employment and well-being for all. So I told you that the money system also is structuring the economy. And what I mean by that is it is literally determining what sectors of the economy, what regions of the economy, grow to a large extent and which ones don't. And what kind of economy, structurally we have, like what kinds of cities, what kinds of, vehicles and so on. So in addition to the volume of banking, the economy is also affected by the discretionary choices that banks make about where to lend and for what purposes. So banks have lending strategies and they have policies that determine the types of loans that they'll make and in what regions. So are we going to lend in a rural community? Are we going to lend in low-income communities? Are we going to loan for housing projects or for small business? Or are we going to focus on lending to large corporations or startups? Or are we going to lend for stock market speculation or not? Or are we going to lend for mergers and acquisitions? These are all decisions that managers of various types of banks make. And those decisions then determine, even what types of loan applications they'll consider and who from and where. And as we just saw, with these lending decisions being the headwater of the economy, this really matters. We've seen a huge contraction of the banking sector, or rather merging in the banking sector, that's left many rural communities with no bank at all. They don't even have a branch, they just have an ATM. So there's nobody in that community anymore that's available for an entrepreneur to even take an idea to, or a home buyer to go to and say, hey, I need help getting a loan to buy a house. They've got to, just put in an application on a website or something to try and get a loan. And many of those, many of the banks who have bought out those rural banks aren't really invested in serving those, low wealth households. So because they're not that profitable. They're not as profitable as, lending for mergers and acquisitions or lending on the stock market. And so the result there is that, profit seeking is de-investing from those rural communities. The other one is regulations, and there are a number of ways that regulations influence those lending decisions. There are credit unions that are only allowed to lend to their members and for certain types of things. And in fact, an important aspect of the history of banking in the United States and many other countries is that we used to have regulations that effectively, drove lending into rural communities and drove lending into not-for-profit credit unions that served, specific communities. Many of those regulations have gone away. And with them going away, profit maximization has become more and more the primary driver of these lending choices. And because it's so much more profitable to lend, to one big corporation than do 100 loans for, small, low-income community members, you can see that these profit predictable result in disinvestment in one area and more investment in others. So the important thing here is to understand that these are green light, red light decisions at the headwaters of our economy. At the level of banking sector as a whole, they are determining what investments receive newly created money and what does not. And this, as I said, powerfully influences what parts of the economy grow and don't. And just to put that again in mind, we're talking about between 2016 2019, banks in the United States greenlit more than $21 trillion of investment per year with newly created money. And I have a colleague in the Money Justice Collaborative who's always like, you have to put $1 trillion in perspective because it's just an unimaginable number. It doesn't mean anything, right? So here's a way to think about how large $1 trillion is. If you spent $1 million every day for the next 2,500 years, you will not have spent $1 trillion. It's a lot of money, right? So banks in the United States did 21 of those every year for 4 years. And these were just normal years, right? This is a huge amount of green lighting and red lighting of what gets investment in our economy. Another way of putting it in perspective is to think about the federal government's budget, right? We have lots of expectations for what the federal government is going to do to, shape our economy and make it meet the needs of the people and so on. But the federal budget of the United States during that same 4-year period averaged only $4 trillion. And, almost 2/3 of that is various types of social benefit programs, Social Security, healthcare, veterans benefits, etc. And those are consumption expenses. They're not investments. So, you can take it down and go, even if the remaining, let's say, $2 trillion of the federal budget was entirely investment capital, it would still be 1/10 of what the banks created in that same time period. And just to keep in mind, there's a greater than sign in front of the $21 trillion there, because the amount of money that banks created in those years is actually probably much larger than that 21 trillion. There's quite a bit of data that's not available. But the minimum is $21 trillion. Importantly, let's talk about the red light. We don't know how much lending banks rejected in those 4 years. It's not reported in the US. But we know it's highly consequential. And we know that because in Spain, business loan applications are registered. And after the 2008 crisis, researchers were able to use that registry to answer the question of whether the economy slowed down in 2008 because businesses stopped borrowing, they got scared about the future of the economy, or because banks stopped lending. And what they found is quite interesting, which is that it was the banks stopped lending. Businesses were actually trying to borrow more, and they were working really hard to try and borrow. They were going to 6 different banks trying to get a loan, whereas these creditworthy banks had before been able to get a loan from one bank, usually the bank that they'd had a relationship with a long time. And why were they trying to borrow more? Because in downturns, many businesses that are viable businesses choose to borrow in order to try and smooth out what they know is going to be ultimately a temporary decline in the economy. But when the banks cut off the lending at the headwaters of the economy, it can become a very long, long drawn out decline that's happening not because of fundamentals of the economy and people, wanting less cars or less houses, but just simply because there's less money flowing into and through the real economy. So that's one way that these green light, red light decisions are structuring the economy. Another way is in terms of wealth distribution. So, as you might imagine, banks, when they're trying to decide who to lend to, they want to lend to the safest credit-worthy investor, and that's going to be your high-income households, your high-wealth households, your big corporations. So again, lots of green lights over there. And what that means is that these already wealthy portions of the economy are able to access investment capital really easily, relatively speaking, and are able to go and buy up the multifamily housing, that everybody else has to rent, right? If the banks were equally willing to lend to low income and low wealth households, they're going to create the money out of nothing in both cases. Then low income, low wealth households could go and buy multifamily housing themselves and charge themselves less rent because they're going to pay off the interest. They're not having to pay off the interest plus a profit margin that is being demanded by the high wealth corporations and households that are buying the multifamily housing in order to extract a profit. And just to put this in perspective, perhaps a little more personally, in the when I was speaking to the class in the auditorium, I asked them to imagine a situation, which is, or maybe I'll, let me do that here. Imagine that you've got 3 people that want to start a business in a community. They want to start a restaurant. And one of them is an employee of Subway, which is a restaurant chain. They've worked in Subway for 30 years managing Subway franchises. And then you've got a high wealth household that has no experience running or working in any household, or any fast food franchise, but they want a local business that's going to make profit for them. And, a Subway franchise is known to be very profitable. And then you've got a third potential borrower to start a business, and that is, and you're the bank here, sorry, you're the bank, and you've got three potential borrowers that all want to start a restaurant. And the third one is somebody who lives in the community, maybe has grandma's recipes that they really want to serve everybody. They want to create a down home, friendly place that their neighbors will love and will be culturally appropriate for that community. And so they've got a completely custom, business plan for a restaurant. Now those three folks come and visit your bank, and you're trying to decide which of them you're going to lend to. Which one are you going to lend to? Are you going to lend for the completely custom business that you don't know if it's going to be a success? Are you going to lend to the person who's doing the known franchise business, but that they've managed for 30 years? Or are you going to lend to the high wealth household that is a very low credit risk because they have collateral that they can put up or whatever else, and they're going to hire somebody who's worked in fast food restaurants for 30 years to manage their franchise for them? Obviously, most likely, if you're a purely profit maximizing bank, you're going to lend to the high net wealth household who has no experience running a restaurant, right? And this is how we have franchise chains taking over, all of our retail spaces in the United States. Because this is the logic of the investment decisions that are being made for the investment capital that's flowing into the economy. So again, that's not just a wealth distribution thing. It's literally structuring our economy. It's structuring the choices that we have when we as consumers are going and passing money back and forth. Now, which industries grow and don't grow? Again, here we have a situation where you can look at the different sectors and types of industries or types of businesses within sectors, and you think about that green light, red light, for-profit bank, they're going to be more likely to lend to luxury housing than they are to affordable housing. Not only because luxury housing is more profitable, but because it also pushes up property values. And when property values go up, every mortgage that somebody is going to take out in the next period is going to be higher than it would have been if the luxury housing hadn't been built and raised property values. And as a bank, you want to make more money, and you make your money off of the interest on the principal. So you want larger mortgages. And in fact, there's a quite well documented case that in the run up to the 2008 crisis, banks were doing things to push prices up. In particular, the Appraisers Association complained that they were leaning on appraisers to push the values of housing prices up. Now, we can argue about whether or not, as some people do, whether or not we need more investment in fossil fuels or we need more investment in renewable energy. But ultimately, right now, those decisions are not being made by democratic groups of people having that argument. In government or transparently, those decisions are being made in the private office, commercial banks, and loans, right? So we're having our economy structured by green light, red light decisions about investment in various sectors and various types of industries within a sector like the renewable or like the energy sector. But those decisions are not being made in a way that's transparent, that's accountable, that's democratically participatory. So what we have right now, the result of that we have right now is that 93% of all of the investment capital flowing from banks into the energy sector today is flowing to fossil fuel development and fossil fuel companies. Only 7% is going to renewable energy companies, right? And again, whether you believe that's good or bad, there are certainly people on both sides who have an opinion about that and believe that we should be having a very strong conversation about whether or not that's the type of flow that we want at the headwaters of our economy, especially when we're talking here about money that's being created out of a publicly granted legal privilege to create money. How is that privilege being created? This is the shared national money supply of the country. Maybe we should have a democratic conversation about which of these things we want more flowing into. I'm not going to go through the rest of those, but just to say, just to give you a sense of just how powerful this structuring is, I just want you to think about this. Let's just say that next year, just for 1 year, just next year, you could, a magic wand is waved, and next year that, these sides are switched, right? We decide that next year, the amount of money that was going to luxury housing last year is going to go to affordable housing. And the amount of money that was going to affordable housing is going to go to luxury housing, right? So now there's tons of money for affordable housing, not that much money for luxury housing. There's a ton of money for renewable energy. 93% of the renewable energy money is going to go to renewable energy. The next year, only 7% is going to go to fossil fuels, right? You can imagine there that just trillions of dollars are suddenly going to open up for affordable housing, for renewable energy, for small businesses, etc. And next year, right now, next year, it wouldn't take decades to get there. You would have hundreds of thousands of people getting jobs to build, affordable housing, solar farms, or solar power panels and wind farms and so on. That's not difficult to imagine. Like, wow, right. If we took $21 trillion and we basically flipped the allocations that they're doing right now, we would have a radically different economy next year. And that's the truth. That is what it would mean. And the important point of that thought experiment is to recognize that these lending decisions are constantly making the economy. They're constantly remaking the economy. Every year, our economy is being remade by these decisions. We just don't notice it because every year they're being remade with the same logic as the year before. And that logic is profit maximization for bank shareholders who have, and banks who have deep tie-ins with, legacy industries and, also, with particular profit maximization goals. So once you see it, like, hey, if we switched this $21 trillion flow around, we would have made a very different economy next year than the economy that has been made up to this point. And that's what I mean by every year this flow is remaking the economy. Right now, it's just being remade every year in the image of the previous year. So if that sounds privileged to create a nation's money supply, it can be regulated, it can be reassigned. And we actually have, evidence that, in fact, in history, for example, during the Great Depression and during World War II, and even in Western Europe after World War II, when countries needed to rebuild their countries, that one of the things that happened in all the countries that recovered or performed well in those experiences, their governments took the fact that there was a legal privilege to create money that was in controlling the inflow of money into the economy and investment, and they regulated it, or they even reassigned it to public banking or things like that, that channeled the money into full employment programs or war mobilization or into rebuilding the real economy. So we know that it can be done. And this is a legal scholar from, he's now at Vanderbilt University, but he specializes in banking and regulatory law. He was the senior policy advisor for the financial reform for the U.S. Treasury following the 2008 crisis. His name is Morgan Ricks. And today he argues that the banking sector should be regulated like a public utility, right? So we could say, hey, this is a legal privilege you're exercising, and it's really important that somebody exercise it. And we want it to be not the government, so we want it to be outside of the government, just like we in the United States don't have government-controlled telecommunications companies. We don't have national electric utilities. We have them outside of the government. and we regulate them to make sure that they're operating, they're supposed to be regulating in ways that are serving the public purpose. And he says, look, banks, deposit banks are endowed with an extraordinary legal privilege. They're licensed to issue deposit instruments. And that extraordinary legal privilege is exactly why we can and should use the ability to regulate or reassign that legal privilege to get the type of economy that we want. So again, the important thing here is that it doesn't have to be this way. If you haven't liked anything of what I've described about how it currently works, the good news is that humans have come up with many different ways of operating money systems and controlling the money creation privilege. There are alternatives that have been very successful at the scale of large modern nations that do not demand, even ones that do not demand indebtedness and endless economic growth. So we can change the system now that we see it. Lastly, I want to share just a couple of examples that really illustrate that point, that we have other options, that there are real-world examples of what I believe and many people believe are better examples. And if I had all the time in the world, I'd give you 10 examples, but I'm just going to give you two. One of them is public banking, and the other one is monetary financing, and it's don't have time to go into it in depth, but these are just two examples of the way that it could be different. They are not by any means the only way or even the best way, but just want to kind of prop open the door to the idea that this isn't, outrageous, it isn't reckless or anything to even consider that this could be done differently. That said, while I'm pointing these as better examples, I am not suggesting that they are perfect examples, right? Or that, yeah, so just want to clarify that. And yeah, you be the judge as to whether or not you think these are better. So the first one is public banking in Germany. Germany is the fourth largest economy in the world. And Germany does have private shareholder-owned banks. About 40% of their banking is done through those banks, but they also have a very large public banking sector, which is to say banks that are not owned by private shareholders. They're instead owned by, they're operated not for profit, and they're owned by other entities. So for example, public banks are owned by, well, I'll explain that one in a minute. Cooperative banks are cooperatively owned by various industries. They're dedicated to lending for specific industries, and the members of those industries, the manufacturers inside of those industries, have a say at the table to help guide investment into their industry in the ways that are most productive. And they have state development banks that are guiding investment into the economy specifically for the purpose of growing and stabilizing the entire German economy. So let's take a closer look, though, at the public bank section. They have a public, locally controlled banking system in Germany that 85% of retail banking is done with. And I have friends and family in Germany who they're all like, yeah, we all bank at the Sparkasse, which is the name of these banks. And they're independently operated, even though they use the same brand, which is this red S over here. They have a 200-year track record of success. They serve geographically distinct regions, right? So by law, each Sparkasse bank is only allowed to serve the people within their particular region. And what this means is that the people making the decisions about lending investments in those regions, they sleep in that region. They're accessible to the people who are in that region, and they are invested in the real growth of the real economy of that region, because they are not allowed to go and lend on Wall Street for foreign currency speculators. If they want to grow their bank, they have to invest in their local community, and the real growth of that community is what will allow them to do more lending in the future. They're publicly supervised. They have a governing board that's made up of local elected officials, bank workers, and local community members. All of this doesn't mean that they're perfect, right? Their boards are overwhelmingly men, and their lending evidence at the time, they're better on those things than in the United States. They have a public benefit mission. They are legally obligated to provide a free bank account to everyone in their geography. They have an obligation to do lending that is of benefit to the local economy. And they actually are expected to help stabilize their local economy. So in bad times, that's when they lend more to offset economic recessions. And they also save up more during good times so that they can do more lending during downturns. Instead of paying out all the profits and the savings to shareholders, they're able to accumulate some of them to help help their balance sheets absorb, losses associated with a downturn. They are not for profit, right? So the profit that they do earn, the interest income that's in excess of their expenses, goes back into the community, as I said, or is held for as a rainy day. None of it is paid out to private shareholders. And one of the things that these banks do is they keep the private banks honest, right? By providing a public option competitor. So in the United States, we've had outrageous instances where banks like Wells Fargo has, basically attacked their own customers, who had checking accounts with them with all kinds of fees and even hidden, expenses and so on. And these types of things, were that to happen in Germany, everybody would say, well, we'll just go to the Sparkasse. We'll stop dealing with Wells Fargo and these private banks that are so hell-bent on making a profit that they would treat us that way. In the United States, we don't really have that option very much. Some places have credit unions. Some people are eligible for them. Sometimes they're small local banks and things, but it's a little over 50% of our banking sector is made up of, I think, 5 banks, right? So we don't, and increasingly they're taking over more and more of the market. So our choice, to go find a better option is limited. Whereas in Germany, they at least have one basic good option that's available to everybody. And as I mentioned, they're expected to lend what's called countercyclically. So when the economy is going down, they increase the lending so that flow into the economy kind of makes up for the downturn. And you can see here that that's exactly what happened after 2008. The local, Sparkasse banks and the cooperatives increased their lending while the private for-profit banks decreased it. And the structuring of the economy that happens as a result of this is profound. When the economy goes down, in Germany, these local banks say, hey, we know that this downturn is caused by like a financial problem on Wall Street, and it's not that people don't want cars anymore or don't want houses. Eventually people will get back to buying cars, and people will need car parts and whatever it is that's manufactured or created or farmed in our community. And so what we are going to do is we're going to lend more right now to tide our businesses over. And so they lend for retooling, for retraining, and for research and development. And this allows their small business and their community to get stronger during a downturn. Whereas in the United States, what we do is we let our small businesses go out of business during a downturn, lay off all their employees, and sell off all their equipment and patents. Which means that when the recession is over and people want the things that they were selling or providing before, it takes a lot of effort to get the economy restarted. You've got to reincorporate new businesses, you've got to hire and train new people, and you've got to rebuy and build all the tooling of the businesses and so on. And there are people who will say, this is actually a chart from a paper that's arguing exactly this, that it is this lending by public banks in Germany that has helped their small businesses become global leaders in their industries. These are called hidden champions. They're small businesses that are the global leader in their industry. And Germany has more of them than any other nation. And they have 3 times more than the United States, which has a population 4 times larger than Germany's, right? So again, This is literally structuring the economy. They have a very strong small business, economy in Germany, and there are people who argue that this is a direct result of how their money system is operated. And so just to go back to that picture and say, okay, what they've got going on here is they've got, local banks here in these communities. They're lending. The interest income is paid out as community grants or is saved for rainy days, while the community-driven while the picture looks the same in terms of lending, creating the money, and interest and loan repayment, the faucets, the handles, are being controlled for a completely different purpose, which is community-driven economic development. So this is one of those alternatives, which is public banking. And we have one public bank in the United States, which is the Bank of North Dakota. It's extremely effective, extremely good at stabilizing North Dakota's economy, supporting small business development, and so on. Yet the United States regulatory frameworks have made it almost impossible, very, very difficult for public banks to be created since that one was founded, I think, in 1919. So 1919, not 1990. And so there are many, many people working on trying to change the laws to make it easier for public banks to be formed in the United States. The closest we have to them today is credit unions, which are not-for-profit, operated on behalf of their members. But with the public banking solution, money still only enters the economy when someone goes into debt. And wouldn't it be nice if we could have a money supply that didn't require somebody being in debt, right? Yeah, so there we go. What if we wanted a money system that creates money without people having to go into debt? And history is actually full of examples of societies using money systems that create their money without anyone going into debt. And you probably heard of some of them, you probably haven't heard of other ones. So, sovereign money, for example, government issued money. There are many instances where governments did create the money and they spent it into the economy and they taxed it back. And they weren't in debt to their citizens, and the citizens weren't in debt to anybody by virtue of the way the money was being created. There's something called monetary financing, which is where governments essentially obligate their banks to create money for the government. And so they have a banking system like ours, but they use regulation or other means to effectively have the banks lend to them at no cost. There's temple and storehouse credits, there's cowrie shells, rye stones, these various examples that you'll find in your economics textbooks where nobody's in debt in order for them to come into existence and be units of exchange. This slide is a little bit jam-packed, but just as just a case study for you briefly, from the Great Depression through the 1970s, many countries used various versions of what's called monetary financing. There's other names for it as well, to obligate their commercial banks to create deposits for the central government at zero or negative real interest rates. Some did this by nationalizing their central bank that then obligated the banks to do this. There are other ones used, kind of complex workarounds that economic historians describe under labels such as, monetary financing or financial repression or fiscal dominance. But in all cases, the effect was to require commercial banks to create deposits, which is money, for the central government to spend, lend, or grant at no interest. And this enabled the paying down of national debts after World War II, extensive investment in post-war economic development in the United States, as well as much of Western Europe and Japan and other places that were decimated by the war. And if you're interested in that, there's a book or an article there titled Liquidation of Government Debt. But there's also a book by Eric Monet, which, shoot, the name of it I'm blanking on at the moment. But it's a fantastic history of that era and those methods. And in fact, in the United States, also in the Great Depression, in one year, in 1933, Congress nationalized half of the banks in the economy. And that was 15,000 banks. And what it did was it said, okay, you need help because you're struggling in this very bad financial environment. If you issue us 50% of your shares, issue 100 more shares, 100% more shares and give them to us, we will help fix your balance sheet. And then for a couple of years before they reprivatized them, or they were not nationalized, the government took a commanding ownership of the businesses. Before returning them to private ownership, they obligated them to do things that were of service to rebuilding the economy during the Great Depression. They had to lend at the lowest interest rates possible on the most patient terms that they could. They had to get rid of excessive executive compensation. They were going to make the same amount of income as other white collar workers. They had to lend for real things like construction and of homes and and putting people to work, and not for speculation on real estate and so on. So all of these examples, you can find the histories of them are actually understudied, and certainly by economists, but also by historians. And they're a part of the history that we should dust off because there's some really good possibilities there. Okay, so I hope that all of that was quite a bit, and because I didn't have the limitation of time here, I threw in a whole lot of stories and things that I did not do when I was actually speaking in the auditorium. And I hope, though, that in conclusion here, that you feel that your time was well spent, that you have a better understanding of money, banking, and the macroeconomy than many mainstream economists, that you better understand how business is done and not done, like what receives investment and why, and what doesn't receive investment and why, what sectors are growing and other ones are starved for investment. And then also hope that you have some sense of why it is that there are some folks who are pretty steeped in knowledgeable about this situation, who are saying, hey, this is not the best money system that humans have ever come up with, and we ought to do something about that. We ought to change it before it drives us into another financial crisis, or into a ecological crisis, or climate crisis, or whatever else. And that you can join with others in raising some questions about that and thinking about other ways that it could be done. Right, great. So thank you so much for hanging in, and feel free to reach out to me if you have thoughts or would like to participate in this conversation in any way.